Hey folks, thanks for tuning in to S News. If you want to stay up to date with stories like this one and catch all our future videos, make sure to follow us, subscribe, give us a like, and drop your thoughts in the comments. Your support really helps us keep going.
Russia is now paying the price for years of war and sanctions, and that price could be extremely high for the regime. Meanwhile, the Russian central bank is printing massive amounts of rubles to keep the government afloat, which isn't surprising. Many Russian banks are going bankrupt, and major institutions are warning they may need bailouts within the next year. Russia's biggest bank is stepping down from operations. Sberbank, the country's largest bank, is blaming huge cash outflows and threats to its staff and property. People in Russia are lining up to withdraw their money, worried they won't be able to access their funds while they still can. This marks the first time in over 100 years that Russia has defaulted on its foreign debt. Russia is facing even more financial trouble today. It's now planning to repay its debts in rubles instead of US dollars. Ukraine shuts down Russia's banking sector in a flash. Before diving deeper into the Russian banking system, it's important to understand some of the major problems in the Russian economy, because banks only suffer when the broader economy does too.
One big issue is extremely high inflation. In 2024, inflation hit 8.4%, and it's now nearing 10%. Prices of everyday goods like food, fuel, and services are rising fast. That means Russians are paying more and getting less. Their money simply doesn't go as far.
For the average person, especially retirees, this is a serious struggle. High inflation also puts pressure on businesses, which are dealing with rising costs for materials and labor. This could lead to major problems down the line.
It's clear how this connects to the banks. When families are struggling with the cost of living, they also struggle to pay mortgages and credit card interest.
When companies face rising expenses, they struggle to pay back their loans.
One of the main reasons inflation is so high is the severe labor shortage in Russia. That's due to a mix of demographic decline, emigration, and the ongoing war. Russia's population has been shrinking for years because of falling birth rates. In 2024, only 1.2 million births were recorded, the lowest in 25 years, while deaths rose to 1.8 million. At the same time, the population is aging rapidly and more people are retiring. That means fewer working-age people to keep the economy running. On top of that, the war in Ukraine led to hundreds of thousands of Russians being drafted or fleeing the country to avoid conscription. The labor shortage has pushed wages higher, which raises companies' production costs and drives up prices for goods and services.
But labor shortages aren't the only problem. Another major driver of inflation is the government's massive war spending.
In 2024, Russia's defense budget hit $140 billion, about 35% of total government spending. This year it's set to go even higher, with plans to spend 6.3% of GDP on national defense. That kind of spending is unsustainable. It overheats the economy and puts huge pressure on Russia's finances.
To fund the war effort, the government has tapped into the National Wealth Fund, originally intended to support pensions and stabilize the economy during crises.
Before the war, the fund had $113.5 billion in liquid assets. Now it's down to just $36 billion. At this rate, the fund could be completely drained by 2026.
Meanwhile, Russia's energy revenues, once a main source of income for the Kremlin, are falling because of sanctions and lower global energy prices. So the government has resorted to borrowing money to keep funding the war. In 2024, the Kremlin ran a deficit of $34 billion, or 1.7% of GDP. This year, it's getting even worse. Most of this debt is financed by the Russian central bank, which, like any central bank, can just print money out of thin air. But there's a catch: printing money increases the money supply without increasing the number of goods and services. That drives inflation. Imagine more money chasing the same or fewer products. And in Russia's case, sanctions have crippled imports, making the situation worse. Ordinary Russians didn't ask for collapsing banks or endless wars, but they're the ones paying the price. Still, a deficit of 1.7% of GDP isn't huge, especially since Russia's government debt is relatively low at around 21% of GDP.
The real problem is that it's not just the government printing money. The government is also pressuring companies to take on more debt to support the war. Banks are being forced to lend, no matter how risky it is. Since the war began, corporate debt has skyrocketed by an unprecedented $415 billion. That's not because borrowing suddenly became attractive. It's because defense contractors alone racked up $250 billion of that debt under government pressure. The benefit? These debts don't show up on the government's books, making defense spending look lower than it really is. But in reality, this still increases the money supply.
According to Ukrainian intelligence, Russia's money supply grew by 24.4% in 2022, 19.4% in 2023, and 19.2% in 2024. We've already talked about how that fuels inflation, but there's another angle: interest rates. Inflation would have been even worse if the Russian central bank hadn't responded by hiking interest rates. Since 2023, the benchmark interest rate jumped from 7.5% to 21%, the highest since the Soviet era. It's currently at 20%, which is extremely high compared to the US rate of 4.5%. High interest rates encourage saving but make borrowing very expensive. The idea is to slow the economy, reduce the money supply, and bring inflation back to 4%. But as long as the government keeps printing money or forcing businesses to borrow, high interest rates won't fix the problem. And since war spending isn't slowing down anytime soon, this puts the Russian economy in a tough spot.
There's also a cost to these high rates: economic slowdown or even a crisis. On paper, Russia's economy looked like it was growing. GDP rose 4.1% in both 2023 and 2024. But most of that came from the war economy, not real economic growth. According to the Wilson Center, Russia now has a two-speed economy. The military sector is booming, while everything else is stagnating. High inflation, a labor shortage, and sky-high interest rates are crushing non-military sectors. Many small and mid-sized businesses are at risk of collapse. In early 2025, Russian companies paid 3.7 trillion rubles in interest, nearly 50 billion more than the year before. By the end of 2025, corporate interest payments could reach 15 trillion rubles, about $172 billion. This is mostly because over 55% of Russian corporate loans have variable interest rates, meaning their cost rises as the central bank raises rates. If those rates stay high, things could go downhill very fast. That's why Russian government advisors are warning of a potential wave of bankruptcies in 2025. About 20% of businesses are already in the danger zone. If they all go under, it would be a disaster. Not just for the economy, but for Russian banks too. The banks wouldn't be able to recover their loans and would face serious liquidity issues. Meanwhile, the Russian central bank is stuck between a rock and a hard place. They need to lower interest rates to save these businesses, but also need to keep them high to control inflation. Recently, the central bank dropped rates slightly from 21% to 20% to give businesses a bit of relief. But that's a very small move and likely all they can manage for now. It's easy to see why Russian bankers are nervous right now.
All of this is happening after 3 years of crippling sanctions. Russian banks were cut off from global payment systems like SWIFT, making foreign trade incredibly difficult. Many banks have been sanctioned by the US, the EU, and other countries, meaning they can't do business with most international financial institutions. Some banks even had their foreign assets frozen, especially the central bank, which lost access to around $300 billion in euro and dollar bonds.
Most of those assets are now managed in Belgium, and the earnings from them are being sent to Ukraine. Without access to these foreign reserves, the Russian central bank has fewer tools to shield the financial system from shocks. One big side effect of the sanctions is that people want to dump their rubles and move their money abroad, leading to capital flight. This puts banks in a tough spot since they don't have enough foreign currency to meet customer demand. The Kremlin responded with strict capital controls. People can't freely convert rubles anymore, and companies with foreign reserves are being forced to convert them into rubles to support the currency.
That may seem like a quick fix, but it's just one part of a much bigger problem. Sanctions are piling up, inflation is soaring, interest rates are crushing businesses. And now we're starting to understand why Russian banks are facing serious trouble and why a full-blown collapse may be closer than it seems.
Russia has 13 banks classified by the central bank as systemically important lending institutions. In simpler terms, These are too big to fail banks. The largest of them is Sberbank, mostly state-owned, and it holds around a third of all banking assets in the country. The second largest is VTB, also mostly state-owned. The third is Gazprom Bank, which isn't owned by the government but is controlled by Putin's close allies from the ruling elite. This tells you something right away. Russia's biggest banks are essentially in Putin's hands, either directly through the state or through his inner circle. They're tools he uses to control the Russian economy.
But lately, Bloomberg reported that at least 3 of these 13 key banks might need to be recapitalized within the next year. In plain terms, that means they could run out of money and need help to stay afloat. This is how banking works. Banks use depositors' money to lend to borrowers. If the borrowers can't pay the money back, the bank won't have enough to give back to its depositors. That's a big problem. One key sign of trouble is the non-performing loan ratio. Basically, how many borrowers aren't paying back their loans? At VTB, Russia's second largest lender, 5% of personal loans are already in default, and that number's rising. Officially, about 4% of business loans across the entire banking sector are in default too.
But here's the thing. Those numbers aren't terrible historically. After the 2008 crisis, Russia's non-performing loan rate hit nearly 10%, and during the 2017 to 2018 crisis, it was even higher. By comparison, the banking sector today looks somewhat stable. Profits seem strong too. In 2024, Sberbank made 1.5 trillion rubles in profit, about $19 billion. Russian banks reportedly hold 8 trillion rubles, which is over $100 billion, in reserves, enough to pay back depositors if needed. That's why the head of Russia's central bank insists the sector is well capitalized and there's no need to worry. But that's extremely misleading.
Banks are worried because the real quality of their loans is much worse than the official numbers show.
It's important to understand that most banks follow the Kremlin's lead. The government has worked hard to prop up the banking system, especially by pushing banks to restructure debt. Debt restructuring means the bank changes the loan terms to help borrowers pay it back, maybe by lowering interest rates, giving more time to repay, or even swapping the debt for company shares. But here's the trick. Once a loan is restructured, it no longer counts as non-performing. That means banks can make their balance sheets look healthier than they really are. But in reality, the risk is still there. The main reason the Russian government wants to maintain this illusion is simple. If people knew how bad things really were, they'd rush to withdraw all their money.
That's called a bank run, and when everyone tries to pull out their cash at once, the bank collapses. It almost happened in 2022, right after the invasion of Ukraine, when many Russians lost faith in the banking system. So maintaining the appearance of stability is crucial, and Putin will do whatever it takes to keep that appearance up. Still, warnings about another possible bank run are increasing. The Russian Center for Macroeconomic Analysis has said that the risk of a run is rising. The bottom line? You can only delay an inevitable crisis for so long.
So what happens next? Financial crises tend to follow similar patterns. When a bank that's, too big to fail is on the verge of collapse, it usually gets bailed out. This can be done either by the government or the central bank. If the government steps in, the money comes from taxpayers or new debt. If the central bank steps in, they simply print money.
And this isn't just theoretical. It has happened in Russia before. During the 2017 to 2018 financial crisis, the central bank bailed out 3 of Russia's biggest private banks. These banks were brought under state control via the central bank's Bank Sector Consolidation Fund. One of them was even turned into a bank that specifically supports the defense sector. But the cost? Over 1 trillion rubles, tens of billions of dollars, basically printed out of thin air. Printing that much money caused inflation and financial instability, but since these weren't the biggest banks in the system, it didn't completely crash the economy.
It also didn't compare to the 2008 to 2009 global financial crisis, when Russia's economy was dragged into a deep recession. Some of the country's largest banks, like Sberbank, VTB, and the Russian Agricultural Bank, faced severe liquidity problems. In total, Russian banks received over $200 billion in bailouts from various sources, including the government, VEB Bank, and the central bank. That's a huge sum, over 10% of the country's GDP at the time. It wiped out government reserves and pushed inflation to 14%, destroying people's purchasing power. No one wants to go through that again.
But the worst collapse in Russia's modern history was in 1998. The country's second-largest commercial bank at the time, Bank, completely collapsed. There was no bailout. Other major commercial banks like Bank and Menatep also went under.
Many Russians lost all their savings. Even people with money in government-run banks didn't fare much better.
The ruble lost two-thirds of its value. Inflation soared to 84%, and the government defaulted on its debt. Sectors like healthcare, education, pensions and public wages were devastated by funding cuts. So will the next Russian banking crisis look like 2017, 2008 or 1998? It's hard to say, mostly because the official numbers don't show how bad things really are.
What we can say is that a collapse seems inevitable. The only unknown is how bad it'll be. What's likely is that Putin won't let one of his key banks fail, so bailouts are all but certain.
But with the government already stretched thin, the money will probably have to come from printing more rubles. That could cost trillions of rubles, possibly tens or even hundreds of billions of dollars, depending on how many bad loans are actually out there, which honestly no one really knows. To prevent panic, Putin might impose withdrawal limits and even use government forces to stop riots or mass protests. But this would come with consequences. Bailing out banks means more inflation because it increases the money supply.
Inflation makes life harder for families and businesses, who already struggle with high living costs and expenses. That makes it harder to pay back loans, which could cause even more defaults. And the cycle begins again.
So, unless it's stopped in time, Russia could spiral into a full-blown financial crisis. Even in the best-case scenario, where the banks survive after being bailed out, printing money will still devalue the ruble. Prices for housing, food and other essentials will go up. The standard of living for average Russians will drop, one way or another.
Finally, thanks for listening and being with us through this story. If you want to keep up with more news and analysis, don't forget to follow S News and watch our future videos. Subscribe, like,